Hello trading friends, and welcome back to Forex Focus, brought to you by tastyfx. Taking a look at the yield curve here today. Haven't looked at this in a while because it's been inverted for a while, but just recently the yield curve dipping out of inversion. If you're watching this and we're back into inverted territory, we might be there by just a couple of basis points, as this has been a volatile trade coming out of all the action we've seen the last week or so. But for the first time in about 2 years, the yield curve in the US has normalized, come out of inversion. And so we're going to look at what this all means technically in the interest rate market, as well as what it could mean for stocks and Forex as well. But let's start with the definition for a yield curve inversion, because you might not know even what we're talking about, though you might have heard, isn't that thing that usually signals a stock market crash? Well, we'll get that in a second. But a yield curve inversion is just when you're seeing short-term interest rates higher than long-term interest rates. And now this can happen a number of ways, but the way that we have displayed here is your most historically accurate version of a yield curve inversion. At least this is what's happened the last couple of times the yield curve has gone inverted, which is, 1 month treasury bills, 1 and 2 year treasury notes, and short-term interest rates are higher than your 10-year treasury note or your 30-year treasury bond interest rate. And of course, the shortest term interest rate benchmark in the US is the Fed funds rate. And if you recall, the Fed hiked that interest rate all the way up to 5.25% to 5.5%. And you might say, hey man, I've been monitoring 10-year yields, which is really the benchmark for interest rates, kind of like the S&P 500 for stocks, but for rates. And you might be saying, I never saw that thing get up to 5.5%. And this is the exact concept that we're talking about here today. Those short-term rates have been much higher than longer-term ones. We usually look at the 2-year versus the 10-year for inversions. That's been really the big trade for fixed income traders the last handful of years. But it can technically be, interest rates are rising as you go out through duration from overnight all the way to 5 years, and maybe the 5-year for some reason has a higher interest rate than the 10-year. That could be an inversion. But we have seen a pretty traditional setup the last couple of years here, which is they hiked the overnight rate all the way up to 3, 4, 5%. That surpassed a lot of the medium term to long term treasury interest rates, and thus we've had a yield curve looking like this for the last couple of years, which is just to say, as you go out in duration, interest rates actually getting lower, as opposed to a normal yield curve where as you go out in duration, if you're going to loan someone money for 10 years versus 2 years, you'd probably expect a higher interest rate. That's normal circumstances, have not been the circumstances we've been dealing with recently. Let's take a look at less of the theoretical and get into the practical. This is here a very colorful and at certain points messy chart, but if you can distinguish the blue line there, the 2-year rate, what we would call the short-term rate in the example that we're posing here the last handful of years, and you can either line that up against the green, which is the 10-year, or the red, which is the 30-year. You see that in 2020 to 2022, that blue line is much lower than the green and red line. Short-term interest rates much lower than long-term interest rates. In 2022, what happens? Inflation spikes, and like I was just talking about, the Fed hikes short-term interest rates, their overnight rate, the only rate that they technically can move, and short-term interest rates spike with that overnight rate, and you see that blue line climb all the way on top of not only the orange and green lines, the 5-year and the 10-year, but appreciably at certain points above even the 30-year yield. And at certain points there, you see the 5-year, that orange line, also above your green and red, the 5-year being above 10s and 30s. And this time around, it was inflationary, right? The whole story the last couple of years coming out of the pandemic was that inflation was ripping too high, and thus the Fed rose those overnight rates and short-term rates rose higher. And if you are an options trader, you're probably looking at this concept and saying to yourself, oh, this kind of reminds me of when there's a spike in volatility and short-term volatility, short-term expirations, maybe your dailies and your weeklies, they see a larger jump in volatility than your monthlies or your leaps. Similar concept here, and remember that when inflation was rising throughout 2021 and 2022, and then it was still high in 23, but remember that was when it was coming down. The idea was this is transitory. And so it kind of makes sense conceptually that interest rates for the next several months to couple of years would be higher than 10 or 20 or 30 years out, because the market wasn't expecting inflation to be high for that long a period of time. We've been hovering around 2% inflation for the majority of the last couple of decades, and now it got all the way up to above 8% at certain points in 2022, hence the hiking that we see here in 2022. That top chart is the Fed funds rate. You see it climbing pretty violently there throughout 2022 and into parts of the start of 2023. But it was never this idea of, oh man, we're worried that inflation is going to be above the central bank's 2% target for years and years and years. Otherwise, you might see that 10-year get up to not only 5%, but 6 or 7%, which is where it has been historically in parts of the 70s and the 80s, the last time we saw substantial inflation like we've seen the last couple of years. And so now the question becomes, okay, the inflation has normalized here, but that Fed funds rate has still been up at 5% plus. Is that going to come down? And the market is thinking yes, and hence the normalization that we've gotten here to 0% or a flat curve between the 10-year and the 2-year. This is the spread between the 10-year yield and the 2-year yield. So essentially those lines that we were looking at a couple of slides ago, one minus the other. And so when the 10-year is higher than the 2-year, when we're seeing a normal curve, this spread is positive. We've seen that it's been negative for the last 2 years. It got all the way down to negative 100 basis points 2 different times in 2023. And that was when there was fear that interest rates were inflation was going to not only get to 8 and 9%, but maybe hyperinflation above 10%. Didn't quite get there. And now we've seen inflation come in. The expectation is that the Fed is going to cut interest rates, and that is most likely going to not only affect all the interest rates along the curve, but it mostly affected short-term rates on the way up. It's likely to mostly affect short-term rates on the way down. And so those short-term rates that have traded over long-term rates for 2 full years are starting to normalize a little bit on that expectation. A little bit of historical context, because this has been a really interesting story that we've almost kind of taken for granted because it's been so long. A couple of things. One, this is the longest yield curve inversion in more than 30 years. 2, it was the deepest negative, I guess you could say worst inversion of the last 3 decades plus. And 3, if you notice there, when are the other yield curve inversions historically? Well, you're seeing one in 1999, 2000 area, and you're seeing the other in the 2006 to 2007 area. Huge bear markets following both of those inversions. And this was the story when we first went inverted, right? Inflation is spiking. The Fed is hiking interest rates to try to calm that inflation. The stock market has just printed a series of all-time highs coming out of the pandemic. We had the pandemic dip and then the crazy recovery after that kind of sparked this inflation. And the expectation was, oh, now our yield curve is inverted. Now we're going to see a crash like we saw in the dot-com era of the early 2000s and like we saw in the financial crisis era of 07, 08. Didn't happen. I mean, that being said, we did see some significant downside in the stock market in 2022, 2023 there as the Fed started to hike interest rates. But by the end of 2023, stock market had recovered, and obviously the first part of this year, stock market has done quite well. So we haven't gotten that same crash that we saw in those historical inversions, but we're not necessarily out of the woods. Of course, this could be now as we normalize the start of a significant bear market, although we haven't seen that yet. And the yield curve was, like I say, the worst and the longest of the last 3 data points. So might just be one of those small data set problems where we only have 2 inversions historically. And of course, there was stress going on. The yield curve usually doesn't go inverted if there isn't some kind of stress, inflation or otherwise. But at the end of the day, did the inversion cause a stock market crash? Probably not. And so it's hard to say that, oh, we got the inversion here in 2022, 2023, so there has to be a crash. Maybe we've already gotten through that stress, or maybe if the Fed has been too slow to cut rates, we are looking at a potential recession. But enough of that. Let's take a look at how this yield curve inversion might affect some other markets outside of stocks, because the U.S. dollar market has been very volatile, not only as we went into inversion, but also coming out of it here. We've seen a lot of volatility, especially against the yen and the Swiss franc. Those are 2 historic safe haven or risk off currencies, and the dollar has really been swinging around against those 2, but also will likely move against a host of other currencies that's maybe not rooted in the inversion normalizing, but more rooted in interest rate activity at all. Remember, we saw some of the craziest prices for US dollar as most central banks were hiking. We saw the parity with the euro. We saw the prints down below 110 against the pound, and that's when we saw the US dollar get up to above 150 against the yen for the first time. Now, does this mean that the dollar has to give away all of the strength that it got the last couple of years? No. Of course, you could have an environment where the yield curve is normalizing in the U.S. The Fed is is cutting down to 2 or 3% over the course of the next year or so. But maybe Japan, who just got into positive territory with their interest rates after being negative for years, maybe they have to cut down to 0% again. And so the U.S. dollar isn't necessarily, it doesn't have to crash. It's a game of relativity. But as that relativity shifts, which it hasn't really for the last year or so, most central banks have not moved rates by much in the last 6 to 12 months. That relativity will likely shift. We'll have some months where maybe euro area data is stronger than that in the U.S., and so the ECB is not cutting and the U.S. does cut, and maybe you'll see some U.S. dollar weakness there. No clue what's going to come, but likely to be some Forex volatility in line with this interest rate activity and the normalization in the yield curve after the longest and worst inversion in the last 30 years.